Private equity and venture capital are two different but powerful forces in the financial world. They both involve investing in companies, but their approaches and goals are distinct. Understanding these differences is key for entrepreneurs and investors alike. Let's dive in and explore these two investment giants. Imagine a company needing a boost, either to grow bigger or to simply get off the ground. This is where private equity and venture capital come in. They act as catalysts, providing funding and expertise to help businesses succeed. While both aim for high returns, their methods and target companies differ significantly. Private equity firms typically invest in mature companies with a proven track record. They often buy out the company completely or acquire a majority stake. Venture capital firms, on the other hand, focus on startups and emerging companies with high growth potential but higher risk. In the following sections, we will delve deeper into the specifics of private equity and venture capital, exploring their characteristics, investment strategies, and impact on business growth. Understanding these nuances will provide valuable insights into the world of high finance and its impact on the businesses we interact with daily. Private equity firms are like skilled renovators of the business world. They seek out established companies with solid foundations, but perhaps lacking the resources or strategic direction to reach their full potential. Think of a well-built house needing a makeover and a talented interior designer to unlock its true value. These firms pool money from wealthy individuals and institutions, creating substantial funds to acquire significant ownership in companies. They aren't afraid to shake things up, often bringing in new management teams and implementing operational improvements to boost profitability. Their ultimate goal? To increase the company's value and eventually sell their stake for a hefty profit, much like a successful house flip. One of the hallmarks of private equity is its focus on operational efficiency. They are experts at streamlining processes, cutting costs, and maximizing revenue streams. Their involvement can be transformative, taking a company from good to great in a relatively short period. However, this transformation often comes at a cost, as job cuts and restructuring are common strategies employed by private equity firms. Private equity's impact on business growth is undeniable. They provide not just capital, but also strategic guidance, operational expertise, and access to their vast networks. This potent combination can propel businesses to new heights, unlocking value and creating substantial returns for both the firm and its investors. Venture capital, in contrast to private equity, thrives on the thrill of the unknown. Venture capitalists are like talent scouts, constantly searching for the next big thing in the world of startups. They invest in companies in their infancy, often with just an idea and a passionate team, betting on their potential to disrupt industries and achieve exponential growth. These firms operate with a high-risk, high-reward mindset. They understand that not all their bets will pay off, but the few that do can generate astronomical returns, more than making up for the losses. Think of them as gardeners nurturing a diverse portfolio of seedlings, knowing that only a handful might blossom into towering trees. Venture capitalists provide more than just funding. They offer mentorship, guidance, and access to their extensive network of contacts. They understand the challenges faced by startups and act as valuable partners, helping navigate the treacherous path to success. Their involvement can be the difference between a brilliant idea fading into obscurity and a groundbreaking company changing the world. The impact of venture capital on innovation is undeniable. By providing early-stage funding and support, they fuel the engine of technological advancement and economic growth. From the internet boom to the rise of biotechnology, venture capital has played a pivotal role in shaping the world we live in today. While both private equity and venture capital play crucial roles in the business ecosystem, their approaches differ significantly. Private equity seeks to optimize established businesses, while venture capital fuels the dreams of early-stage startups. One is a renovator, the other a gardener, each contributing to the growth and evolution of the business landscape in their own unique way. Examples abound of companies that have flourished under the guidance of private equity and venture capital. Blackstone's acquisition of Hilton Hotels and KKR's buyout of RJR Nabisco are prime examples of successful private equity investments. On the venture capital front, Sequoia Capital's early bet on Google and Kleiner Perkins's investment in Amazon stand as testaments to the power of backing innovative startups. Statistics highlight the impact of both investment strategies. According to Preqin, global private equity assets under management have surpassed $4 trillion, while venture capital investments reached a record $671 billion in 2021. These figures underscore the growing influence of both sectors in shaping the global economy. In conclusion, understanding the nuances of private equity and venture capital is crucial for anyone interested in the world of finance and business. Both play distinct but vital roles in fostering growth, innovation, and economic prosperity. Whether it's optimizing established giants or nurturing the seeds of future unicorns, both investment strategies continue to shape the business landscape, leaving an indelible mark on the companies and industries they touch.